There is one ETF you might want to start buying right now, and another one that could quietly cost you another decade of your financial life if you don't pay attention. Millions of people own that second one, absolutely convinced they're on the right side of the future. And on paper, the story makes total sense. But when you actually look at the numbers, the real numbers, it tells a very different story. So today, I'm going to show you exactly which ETF looks genuinely attractive at today's prices, which one to seriously reconsider, and why. In plain English, no hype, just the logic and the math. Stick with me, because how you think about this could change how you invest for the next decade. Why this matters right now. Let's start with why this conversation is actually urgent. The most popular investment on the planet right now is the S&P 500, and normally I love it. Broad, cheap, time-tested, but right now it has gotten expensive, very expensive. Two of the most trusted valuation tools in investing are flashing near their highest readings in history. The first is the Shiller-Cape ratio, which compares stock prices to 10 years of inflation-adjusted earnings. Right now, it's sitting at around 42. The long-term historical average is roughly 17. That means you're paying more than twice the typical price for every dollar of earnings the market produces. The second is the Buffett indicator, the ratio of total stock market value to the size of the entire U.S. economy. Warren Buffett once called it probably the best single measure of where valuations stand. As of August 2026, that number is sitting around 240%, 2.4 times the entire economy. Historically, that is a level we've rarely seen, and when we have, the decade that followed has been disappointing. And here's the single most important rule in all of investing. It sounds simple, but almost nobody actually uses it. The price you pay decides the return you get. Buy something at a discount and your future returns tend to be much better. Buy that exact same thing at a premium, even a wonderful business, and your returns tend to disappoint. That's not a theory, that's math. The dot-com versus 2009. Let me show you a real example that makes this concrete. Imagine you dollar-cost averaged $100 a month into three things, starting at the peak of the dot-com bubble in March 2000, worst possible time. Over the next 12 years, the S&P 500 earned you less than 5% per year. The NASDAQ actually lost you money. But the small-cap Russell 2000, it earned almost 7% a year, a full win, starting at the same terrible moment. Why? Because back then, small companies were cheap, while big tech was insanely expensive, so the same $100 bought a lot more value in small caps. Then flip it. Start from the cheap bottom in 2009. Now the S&P 500 and NASDAQ absolutely crush the Russell 2000. Same investments, completely opposite winner. The only thing that changed was the price you started at. Today's market looks a lot more like 2000 than 2009. That's not fear-mongering, it's just valuation arithmetic. Before I show you the ETFs, let me be clear about something. We're not here to hand you a stock tip. We're here to teach you a process so you understand what you own, what you're paying for it, and what the historical evidence actually says. What you do with that is entirely up to you. Okay, with that said, the ETF I'd be looking seriously at right now is one that tracks the Russell 2000 index. What is that? The Russell 2000 holds roughly 2,000 smaller American companies, everything from regional banks to healthcare providers to defense contractors. Think of it as the other side of America that never makes headlines. Here's why it's worth paying attention to right now. Reason 1. Earnings are coming in strong. Small companies had a rough couple of years. Profitability got squeezed by high interest rates and a weak domestic economy. But as of early 2026, Bloomberg consensus data shows analysts expect Russell 2000 companies to grow earnings by roughly 43% over the next 12 months. The S&P 500, about 11%. When something is bouncing off a beaten-down base with improving fundamentals, the rebound can be significant. Reason 2, you're no longer betting everything on a handful of giants. Right now, the top 10 stocks in the S&P 500 make up nearly 40% of the entire index. The Magnificent Seven alone account for roughly 34%. That means when you buy the S&P 500, more than a third of your money is riding on 7 companies. If any of them stumble, the whole index feels it. In the Russell 2000, no single company makes up even 0.5% of the fund. You're not betting that Nvidia and Apple can keep carrying the entire market on their backs. You're buying the rest of America. Reason 3, it's a completely different mix of businesses. The Russell is loaded with healthcare companies, regional banks, industrial suppliers, construction firms, and defense contractors. These are domestically focused businesses. When the U.S. economy strengthens, when manufacturing comes back home, when infrastructure spending picks up, they benefit directly and disproportionately. Reason 4, the recovery is underway but not priced in yet. VTW, the Vanguard version of this index, has returned roughly 39% over the past year and is up about 22% so far in 2026. The market is waking up to this corner of the market. But small caps still trade at a meaningful discount compared to the expensive S&P 500 and the Nasdaq, which trades at even higher multiples. The recovery is real and happening. It just hasn't been fully priced in. Now, one honest caveat. The Russell's not automatically safer just because it owns 2,000 companies. A lot of these firms aren't yet profitable. Roughly 40% of the index runs at a loss. During a recession, smaller companies with weaker balance sheets tend to get hit harder than the large caps. That's the real trade-off here. You're accepting more short-term volatility for what the data suggests is a much more reasonable entry price. The 3 ETF options. If you want to own the Russell 2000, there are 3 main ETFs to know. They're not identical, so let me make this clear. VTW, the Vanguard version. Expense ratio 0.06% per year. That's just 6 cents for every $100 you invest. It owns the entire Russell 2000 index and charges almost nothing to do it. For someone buying consistently every month and holding for decades, that tiny fee is a massive long-term advantage. Over 20 or 30 years, the difference between 0.06% and 0.75% in fees can add up to tens of thousands of dollars in your pocket for doing exactly the same thing. VTW is the baseline smart choice here. IWM, the iShares version. Same index, same job, but charges 0.19% per year, more than 3 times what VTW charges. So why does it exist? Trading. IWM is enormous and extremely liquid, which makes it the go-to for institutional investors and options traders who need to move huge sums in and out quickly. For a long-term buy-and-hold investor, the extra fee is hard to justify. IWO, the Russell 2000 Growth Slice. This one is different. IWO doesn't own the whole Russell 2000. It owns only the fastest-growing half of it, about 1,100 companies tilted heavily toward biotech, technology, and healthcare growth names. That means more upside potential, more unprofitable companies, and a significantly bumpier ride. It charges 0.24% per year. Think of IWO as the high-octane version of the small-cap bet. It's a valid option if that's what you genuinely want, but for most long-term investors who simply want cheap, broad exposure to small-cap America, VTW is still the sweet spot. And here's something most people never bother to do: actually look at what they're buying. People assume small-cap means tiny, risky startups. It does not. Inside the Russell 2000, you'll find companies like Moog Inc., which builds precision parts for military jets and spacecraft. BrightSpring Health Services, which provides home health care for elderly and seriously ill patients. Viasat, which runs satellite communications for airlines, the military, and everyday consumers. These are real businesses, not moonshot gambles. That kind of broad, boring, real economy ownership is exactly what tends to build wealth quietly over time. The other side of this video? The ETF, I think, deserves very serious scrutiny. And to explain it, I'm going to use the most famous example of this type, ARKK, Cathie Wood's flagship innovation fund. ARKK is almost the complete opposite of the Russell 2000. Instead of owning roughly 2,000 companies, ARKK owns about 47. Instead of being spread evenly across them, nearly 52% of the entire fund is concentrated in just the top 10 positions. Tesla alone makes up about 9.4% of the fund. And instead of charging a small, transparent fee, ARKK charges 0.75% per year, more than 12 times what VTW2 charges. So how has this concentrated, expensive bet actually performed? In 2020, ARKK was up 152.8%. That number is real, and it's the number that got millions of people to pour their savings into this fund, convinced they'd found the next great investor of our generation. But here's what came after. Down 23% in 2021, then down 67% in 2022. At its worst, ARKK fell about 81% from its February 2021 peak. Right now, as of August 2026, it's still sitting nearly 48% below that all-time high. Let that land for a second. Nearly 5.5 years after its peak, including some of the biggest bull market years in modern history, it has not recovered even half of what it lost. And here's the math that should stay with every investor. When you lose 80%, you need to gain 400% just to break even. Most people who chased ARKK in late 2020 and early 2021 have never seen that money come back. Over the last 5 years, ARKK has lost roughly 8% per year. The plain, boring S&P 500, the one everyone said was too expensive, made approximately 13–14% per year over the same period. To be fair, and the criticism is only more powerful when it's accurate, ARKK has not lost money since launching in 2014. Since inception, it's averaged roughly 13% per year, but almost all of that came from one explosive year, 2020, and one explosive stock, Tesla. And the tragedy is that most people weren't there for 2020. Most people arrived after that jaw-dropping return was already on the scoreboard, poured their money in near the top, and wrote it down 80%. That's the actual lesson. Not that ARKK never worked. The lesson is that the people who chased the hot return got crushed, while only the early believers who held through everything came out ahead. Side by side. Put them next to each other and the picture gets clear. The Russell 2000 via VTW, roughly 2,000 companies, no single one above 0.5%. Fee of 0.06%. Rules that don't depend on any one person's forecast, currently trading at a meaningful valuation discount to the broad market. ARKKK, 47 holdings, top 10 positions hold more than half the fund. Tesla alone at nearly 10%, fee of 0.75%. Everything riding on one manager's concentrated bets, still nearly 48% below its 2021 peak after nearly 5.5 years. One is broad, cheap, diversified ownership of real American businesses bought at